This is going to be a short presentation on how a traditional mortgage steals your money and how you can stop it. Hi, my name is Dave Brubaker. I'm an independent representative for United Financial Freedom. And I want to show you how you can become debt-free in 1/3 to 1/2 the time with no change to your budget, no debt consolidation. We're not going to talk about refinancing, and you don't have to go out and get a second job. When people see this, they say, wow, that's magic. And we say, no, it's just math. So the traditional versus alternative, traditional banking tells you to consolidate for a lower monthly payment or to refinance for lower interest rates or go on a biweekly payment plan. But our proprietary program says no refinancing, no standard of living change, no biweekly. That only cuts off 7 years. And frankly, we'd like to have your house totally paid in 7 years. It's not a concept or a theory, but it's been proven now for 15 years. Here's how amortization works. We're going to look at a $200,000 mortgage at 6% for 30 years. And a mortgage, the payments stay fixed each month. But what we're going to do is look at the interest and principal. So in the first month, we're going to pay $1,000 in interest and $199 in principal. In the second month, we're going to pay $999 in interest and $200 in principal. In November, $998 interest, $201 principal. Notice we're only seeing a difference in interest and principal by $1 a month. Just going like a turtle. We have January's payment and then February's payment. And so what we've done in the first 6 months, we've paid out $7,194, $5,983 went to interest, and only $1,211 went to principal. So we've only reduced our mortgage balance by just $1,211 in our first 6 months. And we put out $7,100. Let's look at a summary of the amortization. In month 1, actually, we paid 83% interest, and we were told this was a 6% interest loan. By year 5, we paid out $71,946, but we only have $13,000 in equity, which means $58,000 went to the bank for interest. By year 21, we have built up $100,000 in equity, and we still owe $99,000 on our mortgage. So it took 21 years just to get to the halfway point. And then in year 30, we paid out $431,000. $231,000, that was interest. Folks, that was a 53% mortgage we had, 53% interest. Let's look at a different example. How about a $300,000 mortgage at 4%? The interest the first year, 69%. In the 5th year, we're paying 63%. Year 10 is 55%, and year 15, 46%. So there is a much better way, and I want to show that to you. First of all, I want to ask you a question. Is it smart to take out a 10% loan to pay off a 6% debt? The first time that question was asked to me, I said, absolutely not. That makes no sense. But let's take a look at this. Let's borrow $1,012 from the bank at 10%. What are we going to do with it? Well, here's the mortgage we just looked at a little while ago. We're going to take and pay the principal on October, November, December, January, and February. Now, when you do that, we're saving the interest from those months. So we're going to save, knock off $999 of interest for October. We're going to eliminate $998 of November's interest, $997 December's interest, January's interest of $995, and February's interest of $994. We just eliminated $4,983 in interest by borrowing $1,000. Of course, that's taken off at the back end of the loan. So this is one way to pay down on your principal and get the mortgage out of your life. Now, how to pay off debt early? We do that by utilizing checking account, savings account, credit cards, and lines of credit. Our program generates transfers like we just looked at over to principal every couple months, making sure every dollar is either earning interest or canceling interest. Now, there's 4 requirements to make this work for you. Number 1, you have to have debt. Number 2, you must have a checking account, you must have a savings account, and you must have our proprietary program that gives you instructions. Now, there's an optional requirement, and that's for an advanced line of credit. It will cut off an additional 6 months to 1 year. This can be in the form of a personal line of credit or a business line of credit, a credit card with a $300 minimum, or something we call a HELOC. It's a home equity line of credit. We'll be referring to that in the next couple slides. So, our proprietary program utilizes more than 8 money-saving strategies. Here are just 4 of them. We use interest accumulation, interest float, interest cancellation, strategic payoff. So let's look at one possible scenario. This will be John and Rebecca Jones' scenario. On their income side, they bring in $5,000 a month income. They've got $4,800 a month in expenses, so that gives them $200 discretionary income to play with. On the liability side, they basically just have their mortgage of $200,000 at 6%, and it's the payment of $1,199 that we looked at earlier, and it's for 30 years. They also have a credit card, but they have no balance on it at the current time. So, interest accumulation is one of the principles that we use. In month 1, we're going to get our paycheck of $5,000 and put it into our checking account. Then the program is going to say, well, let's move that over into savings because you're not earning any interest in your checking account. It's 3%. And you say, well, that's not a lot. Yeah, but if you do this on a regular basis over a period of decades, it can account for a lot of gain. Now, we're going to put all of our bills on our credit card. We're going to pay our mortgage with a credit card and our car payment and our groceries, and we're going to pay for our utility bill, all with our credit card. So what we've got is a mortgage has gone down from $200,000 to $199, and our savings account has gained $12. So this is what we call interest accumulation. The second program we use is interest float. So this concept is unique. We've just been using $4,800 on our credit card for 30 days interest free. And what the program is probably going to do is going to say, now in month 2, your income in your checking account, we're going to take $4,800 and pay that off before you have to pay any interest. That's interest float. You can do this. We've all done that from time to time. Now, also in month 2, the program might say, let's take $37.89 out of savings and add it to our checking. And we're going to then use concept number 3, interest cancellation, by moving the $39.89 over to the principal on our mortgage. We'll eliminate 18 payments and save $18,000. So this is interest cancellation. Let's take a look at what we just did. We applied $3,898 to principal. Before we did that, we owed $199,000. Now we only owe $195,000. The result is we reduced our balance by $3,989. Payments remaining, 358 payments before we applied this. Now we only owe 340 payments. So we eliminated 18 payments. And we were going to pay $231,000 in interest. Now we only owe $212,000 in interest. So we wiped out $18,855 in interest. Let's look at it a little different way. If we invested a lump sum of $3,989 and that investment grew to $18,855, we would say that we got a 372% return on our money. Well, folks, that's what we just did. We applied $3,898 to our loan, and we wiped out $18,855 interest. That's the same as if we're getting 372% return on our money. So if you got some money laying around and you're not sure if you want to put it into a stock or the bank or an annuity or whatever, and you're not sure where you can get the best return safely, how about 372% return immediately and with zero risk? Give that some good thought. Number 4 is strategic payoff. So the more debt we have, the more payoff options there are to choose from. These have different loans. Some of them are amortized, some of them are simple interest, some are compound interest. The program takes all that into consideration, and the program chooses which ones are you to pay on and pay off first. So you don't have to worry about that. The program takes care of that. What did we do with John and Rebecca Jones? Well, at the end of 30 years, we ended up paying their Money Max account, paid off their mortgage in 15.7 years. And they paid $125,000 interest instead of $247,000. So John and Rebecca Jones, they saved $121,886, plus they saved 14 years of mortgage payments that they can now stash away for retirement. Let's look at a totally different scenario and see how this might work with some different numbers. So scenario number 2, we have monthly living expenses of $2,800 plus our primary mortgage of $1,199. We have our monthly net income of $5,000, and so our total living expenses are $4,000. The difference here is we have a discretionary income of $1,000, not just $200. So keep in mind, we're using our HELOC, our home equity line of credit, like a checkbook. Your personal dashboard on your proprietary software, we call it the Money Max account, will look something like this. It's going to say that you can pay off your house in 9.9 years if you follow our plan. Pay $67,000 in interest, and the potential is to save $164,600. Now, it's telling us to start by borrowing $6,387 from our home equity line of credit. So month 1, we have a line of credit balance of 0, but we're going to pay our expenses out of that. So we're going to borrow $4,000 to pay our household expenses. And we're going to borrow $6,387 to apply to principal, which gives us a new balance of $10,387. We're going to put our paycheck in there, which satisfies the need for a HELOC to receive a payment each month. Payment's been made, and now we only owe on our HELOC $5,387. And we need to add to that the $44.90 of interest that we're going to pay on our HELOC for the month. So it's $54.32. We canceled $29,215 in interest. We eliminated 29 payments. Month 2 and 3. In month 2, we begin with a loan balance of $54.32, and we take out our expenses of $4,000. So that gives us a new balance on our home equity line of credit of $9,432. We put our paycheck in there. Now our balance is only $4,432. We're going to pay $36.94 interest. So that puts our balance at $4,469.77. And we're in month 3. We're going to pay our household expenses of $4,000 with the line of credit. And that gives us a new balance of $8,469. We're going to put our paycheck in there, which gives us a net paycheck of a net balance of $3,469. We've got to add $28 in interest. So $3,498. That leads us right into month 4. Our HELOC balance beginning of month 4 is $3,498. We're going to make our household payments out of the HELOC of $4,000, giving us a new balance of $74.98. We put our paycheck in there. Again, it meets the monthly requirement to make a payment. And that leaves us a balance of $2,498. And so the program says, well, you can borrow another $4,231 and apply it to principal. And so now we have an ending balance at the end of month 4 of a $67.36. Our 3-month total interest has been $129.90. We canceled $45,666 in interest, and we eliminated 46 payments. What did it cost us to do that? $129. You think about that. Let's jump ahead to month 7. We begin month 7 with a $4,874 balance on our HELOC. We pay our expenses. Our balance is $88.74. We deposit our paycheck. So now we have a balance of $38.74. And it tells us in month 7, we can apply $39.11 to principal. That gives us a HELOC balance now of $77.85. So we need to add $64.88 to interest for the month. So our ending balance is $78.50. Our 7-month total interest paid was $320. We canceled $59,153 in interest, and we eliminated 61 payments. So what did it cost us to cancel $59,000 in interest? $320. Think about that. This blows my mind. Every time I give it, it still blows my mind. So the amortization schedule shows us in month 5, we had 309 payments remaining. In month 6, we had 308 payments remaining. In month 7, we're down to 292 payments remaining, and our balance has gone from $188,000 down to $183,000. In month 8, watch this carefully. We owe $280 in principal that month. That's a $20.86 principal jump in 1 month. In month 7, our principal payment was $259. Now our new principal payment is $280. Actually, our 8-month total principal jump is $81.02. When we started out, our principal for month 1 was $199, and now in month 8, our principal is $280. In the traditional plan, by our 8th month, we would have only seen a principal jump of $9. Remember, we're going up at about $1 a month. So how encouraging at the end of 8 months to be now paying $81 more on principal versus the conventional plan. So we canceled $59,153 interest and eliminated 61 payments. Let's keep going. Our dashboard after 7 months, this is your personal dashboard that's doing your analysis for you. We're still on target to pay off our house in 9.3 years. And we're going to only pay $60,424 interest. Our potential is to save a total of $164,000, but so far we've actually saved and knocked off $59,153 in our first 8 months. And look at this. Our HELOC is low enough that the system's going to tell us to go ahead and borrow another $29.34 and make another principal payment. So how do we compare? Well, with our proprietary software that we call the MoneyMax account versus the conventional plan, the balance after 7 months is $183,000. The conventional plan is still at $198,000. As a matter of fact, on the conventional plan, it would take 5.7 years for our balance to get down to $183,000. 5.7 years versus 7 months. The time to pay off, 9.9 years versus 30 years. And the total interest of $67,000 versus giving the bank $231,000. So choose one. You want to go the 9.9 year plan, or do you want to do the 30-year plan? And with the 9.9 year plan, you saved $164,600, and you also knocked off 20 years of payments. So what is needed to do this is a home equity line of credit, a personal line of credit, a commercial line of credit, a secured line of credit, or a credit card. But that's all changed now. The company has invested millions of dollars and has changed everything, and now we can do everything with just a checking and savings account. You don't even need a line of credit. Let's look at the difference. Here's how the line of credit method works. We're going to get our paycheck into our checking account, and then we're going to pay down our line of credit. And we get another paycheck into our checking account, and we pay down the line of credit even more. And then it reaches a point we call the optimal transfer point, where now this program says you can move money over to pay off your debt. And it will decide if it's best to put it on the mortgage, the car, or the motorcycle. And this month it says, let's pay on the car. In the checking and savings account method, it works like this. We get money into our checking account and we move it over into savings. And then we get more money in our checking account again, and we move it over into savings. And then our savings account reaches what's called the optimal transfer point and suggests moving money over onto the debt. And it makes a decision to make a payment on the principal of the mortgage. So we can do the same thing now with the checking and savings account. You may be asking yourself, well, why do I need this? Why can't I just apply additional money to principal myself? Because the program computes the optimal time to leverage money and float and cancel interest to pay off all your debt in record time. It sounds simple, but the formula has millions of lines of code and many different algorithms hard at work all the time. Folks, this is beyond human reasoning. Banks have relied on this math and timing to make money for them. Now you can begin to bank like a bank. This is much more complicated than just an Excel spreadsheet. It's actually like a financial GPS. If you want to get to point A to point B and we get in our car, we use our GPS to tell us to turn left and right and so forth. And if we make a wrong turn, it's going to recalculate. The same thing happens with your financial GPS. It has a roadmap already laid out to have your mortgage and have you debt free at a certain time. And when we get delayed or get distracted, it then recalculates and puts us back on track. It looks at, do you have multiple streams of income, or is your income commission based? If so, we need to go in and change that on a monthly basis. How much do you owe and for how long? Are the interest rates fixed, adjustable, simple, amortized, compound? It anticipates what's coming down the road, things like vacations, holiday spending, tax returns. It also plans for the unexpected because even the system knows that stuff happens. So your financial GPS guides you to pay off all your debts. It makes all those complicated decisions for you. It stays focused. As you know, human beings can get off focus and we can get sidetracked. It tracks our success, it builds wealth, and it lets you know the exact day and year you will be debt free. As a matter of fact, if you're thinking about buying a motorcycle or a boat, you put that into the GPS and it will tell you how that will work in conjunction with your goal. Will it be a good idea to lengthen paying off all your debt and then eliminating the opportunity to save money? I've seen an illustration where a $23,000 boat actually cost about almost $40,000 when you see that it hindered being able to stash money away, postponed it down the road. So the Money Max account does not move money, does not pay bills. There's no account numbers. There's no security numbers. No one has access to your money. It just operates as an account register and wants to know two things: how much money's coming in and how much money's going out. You can update your account in as little as just 10 minutes per month, not required to be glued to a computer screen. So you can operate it from your phone just as well. It can eliminate all your debt in as little as 5 to 7 years, helps you make educated financial decisions. In many cases, it improves credit scores, and you own the program for life. You can use it on multiple houses. There's no monthly fees, no contracts, no surprises. There are lifetime updates, and you have live customer support and coaching when you need it. So the company has received national recognition. Back in 2008, they received the Ernst & Young Entrepreneur of the Year award. Company only started in 2005, and so they were the recipients of this award. Folks, they don't give this out lightly. They look at a company's financials and their longevity and their retention and their product viability. They look at what kind of an impact they're having on consumers. They've given this same award to Apple and eBay and Starbucks and Microsoft. We've also been featured in many business publications. So our success is evident. I copied and pasted this right from the back of our website that gets updated live. And as of January the 10th, we as a company have eliminated $2.031 billion of consumer debt, which is an epidemic in America. So we're very proud of what we stand for and what we do, and we're happy to be able to help you as also. We guarantee our results. Just follow the system. If you follow the system, and for some reason the results are not there that you were told you would receive, we have a 100% money back guarantee. In the 15 years the company's been in business, they have never exercised this. Everybody gets the results. Or they got the program and decided not to use it, and then it was on their shoulders. You're asking, will this work for me? Well, we can't say for sure. It depends on a couple variables. And the only way to find out is to schedule a free financial analysis with the person who referred you. Then you'll know. So the next step is to get your free analysis. It's very detailed, and it will let you know exactly the exact year, month, and day that you will be debt free. No one's going to give you a strong sales pitch. Let the numbers do the talking. Like we said, it's not magic, it's just math. Let the numbers do the talking. So contact the person who referred you to this video and request your free analysis. If you like what you see, great. If you don't like what you see, great. You know, it's all in your hands to decide to move forward or not. Thank you.